Welcome back to our Sustainability Asia series. My name is Nick Merritt, a finance partner based in Singapore at Norton Rose Fulbright. I'm delighted today to be joined by Singapore-based Senior Associate Nivedita Raghavan, a derivatives expert. Welcome, Nivi.
Hi, thanks for having me, Nick.
Nivi, so we're seeing there's been a real pivot across the spectrum of financial products towards sustainable and green instruments in recent times. How is the derivatives market responding to this?
Well, actually, I think we're seeing the use of derivatives in the space primarily for two reasons. One, it's an obvious source of capital injection and funding for sustainable development aims, but also it's a good way of managing a variety of risks associated with this field, whether that's project risk, credit, interest, FX, or currency. And in terms of product categories, there are a variety of structures and transactions. It tends to be a very bespoke area, but on the other hand, we're also seeing a move towards standardization of templates and documentation. I'm thinking particularly of ISDA in this context, in the templates that they've been putting out in the carbon offset structure. But in terms of broad categories, we're seeing sustainability-linked interest rate and FX swaps, OTC swaps. We're seeing exchange-traded futures and options contract unlisted equity indices that are ESG linked. We're seeing ESG linked credit default swaps, weather and catastrophe derivatives. We're seeing renewable energies and fuel space. We're seeing a lot of power purchase agreements, wind index futures, and renewable energy certificates. So it's really quite a broad spectrum of product types and documents.
Great. And so what sort of transactions in particular are we seeing in the Asian markets at the moment?
Well, in terms of, I'd say, interest rate swaps, these are typically being entered into to hedge underlying green loan exposures. So, for example, there was a deal recently out of Hong Kong where a preferential rate was locked in on the fixed leg of an interest rate swap, depending on whether the counterparty met certain ESG-linked criteria relating to energy efficiency in buildings within Hong Kong. You also have interest rate swaps where the legs themselves aren't necessarily impacted, but say the counterparty meets certain sustainability goals linked to the United Nations Sustainable Development Goals, the bank will then be obliged to, fund or sponsor those projects. In the FX swap space, we've seen a deal in Taiwan where the FX swap was essentially hedging the exposure of offshore wind turbines. And the counterparty would be obliged to pay a premium if they fail to meet a certain ESG score, for example, and the bank in turn would then be obliged to reinvest the proceeds of that premium into specific projects. I think in this case, it was a reforestation project. There was a high-profile FX forward case out of Thailand where I think it was related to the exporting of farming, agricultural products. And the counterparty in that case was obliged to comply with certain key performance indicators that were ESG linked, and then they'd lock in a discounted rate, for example. There have been ESG linked indices. We've seen the Japanese government pension fund has been allocating amounts towards, ESG linked indices, low carbon indices. So there's an increasing use of investment strategy here in the ESG space. In terms of renewable energy and fuels, there are virtually cash settled commodity swaps being entered into, whereby in Singapore, there was a deal recently whereby the purchaser was purchasing renewable energy certificates linked to solar power that was being generated by solar installations on the tops of buildings here. And then finally, in the catastrophe derivative space, we've seen the Philippine government looking to buy insurance guarding against the occurrence of certain natural disasters like flooding and typhoons. And you had the World Bank stepping in as intermediary to effectively move this risk away from the Philippine government and into the international capital markets. So you had institutional investors, an international set of them, entering into catastrophe swap with the Philippine government. And then this starts to look a bit like a CDS, where the Philippine government is paying premiums at regular intervals. And upon the occurrence of a certain loss event and after a certain level of damage, these swaps then pay out. So a real wide variety of deals across Asia.
It's fascinating to see the derivatives market responding to managing risk with such sustainable and innovative products. Thanks very much for joining us today.